Hi there, it's Callum Newman here, editor of the Daily Reckoning Australia, back with another edition of our YouTube channel. And today I'm joined by another special guest who's going to cover off on, I think she's got the toughest job in finance, is what I want to say. And I'll explain why in a second. So it's Elizabeth Moran, who's the chief editor of a service called Fixed Income News. And the reason I say she's got the toughest job in finance is Australians as a whole don't allocate a lot of money towards bonds compared to US investors and UK investors. But it's a very important asset class. And I saw a stat the other day that it's at least, I think it's over a trillion worth of assets in Australia, at least. But I'll get Elizabeth to fill us in. Thank you for joining me.
My pleasure, Callum. Great to be here. Thanks for having me.
I went to reach for the figure of the total size of the fixed income market in Australia. What actually is it? I'm sure it's over a trillion or maybe even two now.
It is over a trillion. I haven't looked at that stat for a while, but with growing government debt, which adds to that figure, I would think it would be well over a trillion now.
And so one of the reasons I wanted to get you on, because we're going to talk about three things today. One is what's going on in the housing market with really low mortgage rates and whether you think that's going to stick around. The effect of the QE policy that we all hear about and half of us don't understand, but that's coming from the RBA and how that's sort of ricocheting around the market. And a little personal interest of mine, which is the rise of residential mortgage-backed securities again, which I see going on, and I want to get your take on it. So let's start with housing, though. We're seeing a pretty big lift in credit going out. Is that something you're watching and starting to take notice of? And do you think it can keep going?
I've actually been watching it for many years because Australian households are some of the most indebted globally. So we do tend to take on a lot of mortgage debt to buy the house of our dreams, and the market allows us to do that. What's happened with this current crisis and rates going so low is that it's been a big incentive for investors to borrow more to get the house that they want. And of course, it's pushed prices up. So low rates makes it much more affordable. You can afford to borrow more. But it is a concern of the international credit analyst movement, if you like, looking at Australian household debt because it still continues to rise.
Also, I was just going to say, one of the things with that we've seen since the COVID crisis was the RBA giving this cheap funding to the banks. Is that what's driving the rates down so low, or are there other factors at work?
So that is one of the factors. Of course, just natural competition. You know, there's a lot of non-bank lenders out there as well now that don't have the overhead costs of the major banks or the high street banks. They're just online, so they can offer even cheaper rates. So there is a lot of competition in that market. That's one of the factors as well. I think the term funding facility has really allowed credit, and when I say credit, I mean loans and money in the system. It's allowed that money in the system to put downward pressure on rates. Of course, the government wants us to spend. They want us to invest and spend, businesses to invest. And that is one of the factors that has reduced the rates. Do I think they're going to stay low? I actually do think they will stay relatively low. I think they might come up a bit once that term funding facility ends in about 3 years' time. That term funding facility has enabled the banks to borrow very cheap money at 0.1% for 3 years, keeping overall rates down, liquidity going, enabling us to borrow more, if you like. But looking at longer term, you know, what's going to force interest rates up? We haven't been able to get inflation back into our economy. We did see an uptick in inflation the last quarter to 3.8%. If you look at the underlying figures for inflation, that was based on coming up from very cheap fuel prices, and fuel's a big impact on inflation because if you think about goods and services, how do they get to their final destination? Well, it's transport and fuel costs, and also free childcare came off in the last quarter. So the 3.8% in the last quarter looks high, and it's like we're getting great inflation. I think it'll come right off.
So when you talked a bit about the non-banks there, and I mentioned that's something I've started to follow particularly, they issue bonds, of course, Do retail or sort of private investors buy those, or do they generally go to institutional investors?
Nearly all the bonds and fixed income assets in Australia go to institutions. Very few actually end up in the hands of individual investors. That's because the market here really hasn't been set up for retail or individual investors. It's really dominated by the institutional investors. And when I say institutional investors, I mean other banks, superannuation providers, insurance companies, companies. So they're taking the investment. And if you think about the company, say I'm BHP and I want to issue $1 billion in bonds, I'd much rather just satisfy 20 large investors than, 2,000, 3,000, 4,000 individual investors. It's going to be cheaper for me and quicker for me. So the market really hasn't been set up to encourage that, individual investors to get into it. It hasn't really allowed them to even.
It is true in America, though, that they generally, like a private investor will have like the typical thing was a 60-40 kind of setup with their, what they would call their 401k, what we call super here. But as far as I know, in the US, you just ring up the US government and you can go, I want, 10-year treasury, $1,000 worth. I mean, are you trying to push people to allocate more to bonds? Because I know we have a very high concentration here in Australia of people sort of overinvest, so have a very high allocation to stocks relative to other countries.
That's certainly true. The Fixed Income News Australia, the website where I'm editor, we're advocating for the asset class because people don't understand it. You're not naturally going to invest in something if you don't quite understand it. So it's like an education, news, information site. Would I say I would encourage always investors to look at different investments. I think we're, as a society, way too overinvested in shares, and look, they've really delivered, and especially in the last year or so, huge returns for investors that bought in at the dip. But they are volatile, right? And just as you're approaching retirement and even in retirement, can you afford that volatility in your portfolio? Well, if you've got $20 million in your, as your nest egg, if you lose half, you're still going to have a really good life. But if you've got, a smaller amount and, whatever that amount is, $500,000, $2 million, $3 million, if you lose half of that, in a volatile market, and I think I'm just going to qualify that volatility because we've always seen the market rebound. And so people tend to shrug off that volatility, but there's not necessarily any guarantee that that's going to happen, that we will get the sharp rebounds going forward. So I think the way I try and explain it is, in your mind, think of the capital, you need as you're approaching and in retirement to live comfortably for the rest of your life, and put that into less risky assets such as bonds, such as fixed income bonds, corporate bonds, government bonds, and then use the rest to invest in growth assets. I just think you need to, you work 30, 40 years to build a nest egg, you hit retirement, you have plans with what you want to do, maybe you want to leave some to your family. I think just think about it slightly differently. It's not all about getting a 7% annual growth return or 7% to get a reliable income in retirement. If you're getting 7% in this market, not in any investment, it's a high-risk investment. Probably 4%, still a pretty high-risk investment as well. Lower risk, and I'd talk about investment grade. So credit ratings, investment grade is BBB- and above, anything in that sort of area. Should give you comfort, sleep at night, and you probably earn, 2.5% to maybe 3%.
So we talked a little bit or touch base on the QE at the beginning, where the Reserve Bank comes in, buys bonds, and that pushes down their yields, which makes them effectively less attractive to some investors because they go, well, I can't get a return. What are your view on the RBA's QE policy? Do you agree with it? And do you think it's causing dislocations in the markets anywhere, or is it part of this inflation of the share market and housing market that we're seeing now?
So to start with, I think, and we perhaps forget, but underlying is a fairly unwell economy. We've got a lot of people out of work at the moment, rising numbers of unemployment, particularly in New South Wales. businesses, small businesses, which generate a lot of income and employment for the country, they're closing. So I definitely think the quantitative easing has been needed here, and I think it'll be needed for some time. One of the consequences of that, of cheap money, is inflating other assets such as shares, because all of a sudden they become a lot more attractive. A 3 or 4% dividend yield's a lot more attractive than a 1% or virtually nothing. If you've got money sitting in the bank, you're probably going backwards. So that becomes a lot more attractive, and investors take their funds out of those zero performing investments or low performing investments and push them into the higher yield investments. So again, just pushing up prices all the time of shares and pushing up prices of property. Are there bubbles in those markets? I don't know. All three, bonds, shares and property, they're all cyclical. It's just a matter of investing, I think, where you personally are comfortable with your range and your portfolio.
And so for an investor, do you sort of steer them towards the ETFs now, that way you can just sort of trade them on the share market as such, but you buy a bundle of them? Or that's probably the easiest way to do it, right?
Definitely the easiest way to get into fixed income is an ETF. There's a number of active ETFs now, which are different to passive ETFs. So a passive ETF just tracks an index and aims to replicate the index. And some of those indices have a lot of government bonds, and government bonds are fixed rate, take interest rate risk, and are more volatile at the moment. We see yields going up and down, so prices going up and down, and possibly some negative returns on those ETFs, highly weighted to government bonds. But the active ETFs are quite interesting, where the manager, if you like, might say, instead of replicating an index, and I'm just going to take an index everyone knows here, the ASX 200, that's of course not a bond index.
Yep.
But that index we all know is heavily weighted to banks and miners. So some, if you like, active managers might cap a limit on banks and miners in the indice and work, not actually work to replicate it, but work to better that indice. So there's some interesting ones of those as well. They're also quite targeted now. So you can get floating rate fixed income ETFs if you're worried about interest rates rising. You can get ones that deal in emerging market government bonds, which is quite an interesting segue, if you like, into higher yields. Yeah. And we still know some emerging market countries have defaulted, Argentina being one. So there's some quite diversified opportunities there. Also in the managed fund space, we're seeing managers use derivatives, not to take bets, but to hedge necessarily against some of their positions. So some of those funds are doing very well as well. They're still up around 4, 5, 6%. And going back to the year end, some of them were looking at close to 10%, called absolute return funds. So they actually invest in underlying government bonds, but use a whole lot of derivatives and take positions on those government bonds.
Do you think it's interesting that I know in the US they have, or others have a massive bond market, corporate and government, but they have the sort of like the gurus. They've got Gunlark and I forgot that guy that was Bill Gross, that was like the king of the fixed income market or whatever. We don't really have the equivalent of these guru guys of in the Aussie bond market world that sort of make public appearances and go, I'm betting against the, all these big ego sort of stuff. Do you think that's part of why people don't really follow this market? That it seems very niche and off to the side, and all the actions in the share market?
It's certainly not as sexy, right? But it's there when you need it. And we have a couple of well-known commentators. Chris Joy's one who speaks, has his column in the AFR on a regular basis.
Because so these guys make money, right? They make good money betting when they get their bets right. Like, it's not like it's not profitable for these funds.
No, not at all. So just the Beta Shares hybrid fund, which is a collaboration with Coolabah Capital, which is Chris Joy's company. That fund, for example, now has it's over $1 trillion in the fund.
Wow.
I think it's 1.3 trillion in the fund. And it's earning, about a 50 basis point fee per year. They generate income and good income. That fund's made some really good calls on the market, bought in when, yields spiked and prices were low. And so that, active managers can add to returns of a portfolio. They don't always get it right and they can get it wrong. One of the things to watch in the managed fund space is if the fund's leveraged, because if the fund's leveraged and the calls go the wrong way, you can make substantial losses. And equally, if they're currency, if they're global bonds, and if they're hedged or not, you take an extra bet on the currency, the currencies involved in the fund. So,
well, I mean, I think the point for when you talk about an allocation to bonds is you're trying to avoid that March 2020 situation where your whole retirement income is just getting absolutely butchered while the share market goes down in a big way. That's sort of like your defensive side of it, but there is profitable little niches you can go after, and of course they're income investments. So if you're looking for cash flow, it's a logical place to start.
Certainly, I just should mention a number of them pay monthly income, right? Which is what you want to replicate when you go into retirement. You want an income to pay your expenses. So I think just that fact alone would make some of them, particularly interesting to.
So when you, just to summarize, okay, you've got the asset class there, you've got corporate debt, you've got government debt, state government bonds. You can do it via the share market to even simplify it. When you see debates though that come around in the share market or the financial world, like earlier this year we had the bondcano when inflation was going to spike and then bonds went the other way and the bull market resumed and all that. Do you have views on that, on whether we are going to see a big spike in inflation or it's going to be lower for longer, or do you just observe things as they sort of happen?
Oh, look, for years, Callum, I've thought interest rates were going lower, and I'm talking about 10, 12 years ago, I was advocating for lower interest rates because I just don't, and I still don't see where we're going to get growth from. This country is fairly reliant on its resources, exports. We're talking about getting out of coal and declining, need for some of those other minerals. So where's all this growth going to come from in our economy? We actually have more leisure time than ever. Travel, gaming, some of those sort of popular pastimes, should do well long term. But I just don't see the growth here. Our population's stagnant without immigration, and we haven't had immigration for a few years. That's going to hurt growth going forward as well. People are out of work, trying to retrain. I mean, I think we're still, yes, there'll be a rebound, and yes, the growth will be exciting when we come out of lockdown, but things will stabilise. I just don't see a lot of inflation going forward. I don't see high inflation rates. I think it's temporary. I think the government will really struggle to get inflation to the 2 to 3% band in a sustainable way. That's what the RBA keep talking about, and they want to see it in a sustainable way. So not just 1 or 2 quarters of it sitting in there. And we've had inflation under that 2 to 3% target for sort of 6 or 7 years now. It's difficult. It's not an easy thing to increase inflation, but it's where I think the government they want to increase inflation because that will reduce our debt burden.
Yeah. All right. So you're interest rates lower for longer. We'll put you in the lower for longer crowd. That's me. If you want to follow you, just with fixed income news, do you guys do a daily email or is it weekly or how does it work?
So we do weekly. We have quite a lot of education resources on the website itself, but also news. We're wanting people to understand what's going on in the market. But just have a look at the website and subscribe for a weekly newsletter. And also, have a chat with us. If anything you want to see or learn about, let us know, and perhaps we can help you.
All right, well, we'll leave it there for today, but let's do it again in say 3 or 4 months, and we'll get maybe an outlook for the property market, et cetera, again, with where rates might going, because you never know. One thing we do know about this business is things are always changing. So we'll chat back in. So thank you for joining us.
Absolutely. Thanks for having me, Callum.